100, so nothing very much in terms of a gap between what's up and down, but holding on. You got about, 15, 16 names which are lower, some starting out and the rest higher. So you got more up than down. At least that's the Nifty heat map, the indication coming through. Prima.
Well, it helps that Asia's firmly in the red. You've got a 1 percentage point plus gain for Hang Seng, Nikkei and Korean markets to, as we begin trade. So that's helping us open up in the green. The mid-cap index is up 0.6 of a percentage point, but the small-cap index is more on the flatter side. Advanced decline ratio in favor of the stocks advancing. 3 stocks in the green for 2 in the red. The top Nifty gainer on expected lines is Kotak Mahindra Bank. As Goldman Sachs says, the company had seen a sharp price-to-book de-rating of 10% since the announcement of the credit card ban. And this is a re-rating event for the bank as it kickstarts a key revenue engine for the bank, improving the earnings visibility. So that's the top gainer. It's a fresh 52-week high on Kotak Mahindra Bank. Other gainers include the pharma names. So Dr. Reddy's Cipla make it to the second and third position in the Nifty gainers list. You've got Dr. Reddy at Sun Pharma as well. So the top 5 Nifty gainers include 3 of them in the pharma pack. BEL, Coal India, BPCL, so some of these PSUs are also rebounding. On the way down, it's Titan, top loser, Eicher Motors, Hero MotoCorp correcting a bit, so two-wheelers in reverse gear. Shriram Finance rallied towards the end of trade yesterday, so it's giving up some of those gains. And Tech Mahindra has a cut of nearly 1%.
Well, that's right, Rima. The stocks that are really taking it on the chin is Natco Pharma. That's down close to around 16%. NHPC as well as a little bit low. Actually, that's recovered a little bit. On the flip side, in terms of the top volume gainers, Manappuram, beautiful move out there. That's up close to around 3%, maybe a bit of rub-off impact. We know that gold prices as well have been firm, so that helps their case in terms of their potential to grow. You also have Patel Engineering, that's up 2.5%. TVS Supply Chain as well as up close to around 2.5%. And Easy Trip is higher as well. Keep in mind, some of these stocks we're highlighting, they have moved up only because of the high volumes that we're seeing. Otherwise, from the peak, actually, I've seen some of those stocks, they have taken a hard knock. Other couple of names from the broader markets that are moving up. Honasa, wow, 6.5% out there. But that's another stock that's seen a big correction from the top. And I think Suven Pharma as well, we'll get the management later on the show, maybe at 10:30 a.m. odd. That stock is opened up in the green. And Tilaknagar Industries, the stock that Prakash was mentioning earlier today, they have that battle in the courtrooms with allied blenders. But for the time being, after correcting from 450 to 250, the stock is moving up close to around 3.5%. Prashant.
Absolutely, and absolutely, it's 200 rupee correction, right? 2 days flat, so a bit of a lift coming through. Bharat Forge, I think, as we mentioned, is down about 4% or so. We'll put out more stocks in a bit from now. The market, of course, is indicating a slightly higher start, but it's tentative. I mean, neither here nor there. That kind of a situation. Amish Shah is with us. He's our market master of the day, head of India research at BofA Securities. Amish, good to have you back on the program. It's good to see you. Good morning, Prashant, this side. Bring in the global intel that BofA has and sort of shine it sharply on where we are at, Amish. The India market, which is, it's been terrible last few weeks now, right? Relentless selling from foreigners, and of course, all the news flow, etc. How are things looking? Let's just start at a broader level and then we'll drill it down to individual sectors, etc. Amish, you'll have to unmute yourself.
Prashant, I would say we are a part of that correction as well. We went bearish on the markets back in August last year. We are still not getting constructive. I think this is a year where Nifty is likely to deliver only a single-digit return. Which is more like making a fixed income kind of returns with equity risk, which is not something that we are getting excited about. Mid and small caps, we think, are still expensive, can continue to correct, and therefore one should expect even lower returns than Nifty, possibly even negative returns. So not in the bullish camp as yet.
I should say, ouch. Straight off the bat, I thought you'd keep it for later. So still not changing your bearish view and expect single-digit returns, and mid caps and small caps maybe actually lower from here. Is that what you're saying, Amish?
That's what we are saying.
Okay, got that. Now let me offer, and I'm sure clients also maybe offer pushback. I don't know, but at the margin, right? Some of the things are changing. 2 quarters, government spending has been very slow. That seems to be picking up. RBI is certainly easing. There is a marked shift, right, across, say, forex management, liquidity, rates, regulatory aspects, etc. Maybe we're reading too much into it, but it's a change. New dispensation or not. Don't these things at the margin make a difference? Will they not make a difference, Amish?
So Prashant, they do, or you are very right that sequentially, whatever you look at, whether it is capex growth, GDP growth, corporate earnings growth, everything is on a sequential basis likely to improve. But at the end of the day, despite this improvement, if we are going to see consensus cutting estimates, whether it is capex focused sectors or GDP or corporate earnings, then I would argue that that is still a reason to stay bearish. Despite the sequential improvement. In other words, a large part of that sequential improvement is known and more than adequately still priced in.
So is this a valuation problem then? When we say that valuations are too high, it's also an indirect way of saying that earnings are not coming, right?
So Prashant, if we were to look at it arithmetically, think of it like this, that we will agree that India is currently in a cyclical down cycle or a growth moderation phase. And as a result, it is very hard currently to justify valuations higher than the long-term averages. Even after the correction in Nifty is still trading at 4% higher than long-term averages. And so ideally, that 4%, should become zero. So you're talking about negative 4% from a valuation standpoint, and you probably put 10-12% of earnings compounding through this year. There you're talking about the single-digit returns that I spoke about. So it's a combination of earnings being weaker as well as valuation unlikely to be able to justify in the context of those weaker earnings.
Amish, let's get to the portfolio calls then you have. In August of last year, you had downgraded industrials. So names like ABB, Siemens, BHEL, Havells, and these stocks have corrected 30-40% from its recent peaks. Is the correction done, or do you think valuations are still expensive and there is more downside? At what point do you start turning constructive on industrials?
So Rima, unfortunately, still more downside. So to your point, back in August, we downgraded 13 out of 14 stocks that we cover within the industrial space straight from buys to sells. And that is predominantly my coverage getting into a sell rating. Despite the correction that we've seen so far we've been able to upgrade only one stock and that to a neutral. So I have 1 buy, 1 neutral, and 12 sell ratings or underperform ratings. So look, Rima, I think on capex, between FY21 to FY24, which was a phase of capex upcycle, the industry saw 20% order flow growth, and as a result saw anywhere between 20 to 30% earnings growth as margins improved, working capital cycle improved, and so on and so forth. Now we are arguing that the capex cycle growth is going to moderate to 13%, and as a result, these companies will be able to deliver only mid-teens kind of earnings growth. Which is the adjustment that the markets needs to do, both in terms of earnings cuts and valuation multiple expansion. To your point, on the back of 30-40%, a large part of that is done, but we are not there yet. So still in the bearish camp on everything to do with capex, so not just industrials, but we are as a result also bearish on cement, steel, energy, power utilities, anything that concerns the capex cycle.
Okay, all right. Hi, Amish. Good to see you in. Well, you're sounding, quite cautious actually on the markets, to say the least. But there'll be a couple of sectors that you're positive on. I think the consumption pack, staples is something that you'll have liked. Give us the top 2-3 sectors that you'll are bullish on so we can liven things up a little bit.
Sure, Nigel. So, we are currently positive on a rate-sensitive sector, some internet, some financials. And given that our views on markets are cautious, we are also defensively positioned in healthcare and telecom. On the consumption bit, look, getting into the budget, we did anticipate that there will be a demand stimulus, and as a result, we do like consumption stories, because the benefit of the subsidies to the lower income households and the benefit of tax cuts now to the middle income households is a positive. But that will trickle down slowly through the year in the form of monthly subsidy payments or the tax savings that you would have. Other way to also look at it is that $12 billion or 1 lakh crores of the tax stimulus that the government announced is a good news, but is only 30 basis points of GDP. It is also less than 1% of the India's retailing market. So can it lead to a broad-based growth and a very high spike in terms or a turnaround in the entire consumption basket? Not really. So we are more stock-specific, selective in liking the consumption theme. We are currently positive on jewelry, travel tourism, cigarettes. We are positive on autos, and then finally some of the staple names as well. So very selective within staples and discretionary. We are not broad brush positive on everything consumption yet.
No, got that, and point taken. So this is, you mentioned one number. You said 4% more contraction in valuations, or did I get that right? Or were you talking about, just wanted to clarify that earlier.
So Prashant, that was for Nifty. For Nifty to come to long-term averages, valuations for Nifty needs to correct by 4%. In the meantime, earnings compounds by 12% through this year. So if I'm looking at the mathematical way of looking at Nifty, then it will be -4 plus 12 equal to possibly 8% returns for Nifty this year.
Okay.
What are your global counterparts talking about when it comes to FII flows? We've seen relentless FII selling. The ownership is at a decadal low now. And there is a possibility, I mean, the dollar's getting stronger. Perhaps the Fed doesn't cut this year in 2025. What's going to happen on the FII flows front, to your mind?
So Rima, I think FII flow continues to stay weak because, just think about it, that the 10-year bond yields in the US is about 4.5, 4.6%. That basically means that the hurdle rate of returns that you expect from emerging markets like India is about 15%, right? Because 4.5% you are getting risk-free dollar return. Add to that another 4-5% rupee depreciation that is widely expected. So that takes you to 9% rupee return, risk-free. And then you would expect 500-600 basis points of equity premium because of you wanting to take equity risk and not a safer asset like a bond. So 15% return, arguably, as I'm highlighting, 15% for the markets as a whole is difficult to justify. For some stocks, yes, but for the market as a whole, difficult to justify. Then why should why should the FII flows be positive India? They will continue to look for US treasuries, US equities. We do think that developed markets this year will outperform emerging markets, including India. And on the point of FII ownership being too low, I get that all the time from investors as well. But I would say that, investors will go where there are returns. Just because their ownership has come down, that is no reason why they will add up. So you can, so FIIs can always first scale back on their ownership, and as and when India gets attractive, they can always scale it back up.
All right. All we can do is do our bit, right? Keep the SIPs going. That's from a domestic liquidity standpoint. But let's focus on another theme that I think you're quite bullish on, which is the healthcare space. And overnight, you had some commentary that even if there are some reciprocal, tariffs, autos as well as pharma could get some kind of a leeway, which is good news as well. Tell us, how do you all want to play this particular theme, the healthcare theme?
No, so absolutely. So healthcare actually fits in quite well. It is a defensive sector, so in a weaker market makes sense. It is obviously also inelastic demand. It is difficult to move supply chains, even from a tariff perspective, even if they want to look at it. So it adds up quite well. Valuations are not as rich in that space. And there are some of the cyclical stocks like generics. There are some structural themes like hospitals. So as a pack, we do like healthcare. It's an overweight in our portfolio as well.
Amish, I don't know if you or your global team has published anything with regards to the Trump-Modi meeting tonight and implications of reciprocal tariffs, etc. If you have, would love for you to share that with us. What's the how is the BofA team thinking about this?
Prashant, honestly, on that, we don't have a strong view. The general assumption is that India is too small a trading partner from a US perspective. And as a result, there isn't likely to be too much damage, but that's a hope. Clearly, even the markets are not pricing in too much risk yet from anything going wrong in terms of those discussions. So from my perspective, actually, it's a neutral to a negative event for the market.
Neutral to a negative event for the market. Any thoughts on the forex side here in India, dollar rupee, Amish?
Sure. So the view is that, as RBI is now saying that they will let the currency play its own role. They are only going to look at very large swings, like the way we saw a couple of days back where RBI intervened again. But otherwise, we do think that rupee depreciates. 88.5 is currently our house view, from a near-term perspective. And the 9% overvalue valuation of rupee, we think will only close in gradually over a couple of years' time, not immediately.
Any thoughts on sort of export sectors, pharma, IT? If you've sort of touched upon specifically IT, Amish.
So, Prashant, IT is the only sector where we are sitting on neutral weight, and we are basically telling investors that, just go and hug the benchmark. Because if you think about it, from a business momentum perspective, clearly the growth from the US tech spends is going to improve. So we can't complain. It's actually good news there. But at the same time, a lot of that excitement is already known. Earnings growth for IT sector, therefore, is expected to be 13% if you even include the rupee depreciation gains. And as a result, the valuations of these stocks are close to 28, 29 times 1 year forward PE multiples, which is not necessarily cheap. So on one hand, you have a good business momentum, but on the other hand, not comfortable valuations, which keeps us neutral weight. And that's the only neutral weight that we have in our portfolio right now.
All right, I mean, just to clear this point on the headline index, at best you get high single-digit returns for the year. At worst, what do we go down to in terms of to bring valuations at par or make it relatively attractive? Downside risk is something that will be closely monitored, given the kind of headwinds that we're seeing, slowing economy, not that great growth. So on the downside, how much could we extend? Just on the headline index first.
So Nigel, I think downside risk principally is only external, which is the Trump tariffs, if I were to call it that way. That is the only key factor that I would watch out for. Most of the other factors, I would say, are domestic linked and is relatively easier to model. So we know that earnings growth expectation of consensus is high. We need to knock it down. Valuation expectations are high. We need to knock it down, and which is how we are arriving at that 8%, 9% kind of returns for Nifty. So I don't think minus something coming out of the Trump tariffs, I don't see too much of a downside risk as far as Nifty is concerned, because anything undershooting beyond that, we will get FII interest looking to buy India again. But on the mid and small cap side, I do think there are quite a lot of downside risks, because in a slowing growth environment, first of all, the large cap companies will try to gain market share from the mid and small cap companies, meaning obviously to shore up their growth. Secondly, from a positioning perspective, investors also will want to get more into large liquid names, from a capital protection perspective, so even that hurts. And otherwise, we have seen that, during market down cycles, margins and working capital cycle for mid-cap, small-cap companies typically deteriorates, which is not even priced in or expected in the earnings expectations of these stocks. So mid and small caps, I definitely worry, not so much for large caps, really.
All right. Amish, good conversation today. Thank you very much for joining us. And it's a pleasure. And hope you come back again as we revisit these views if there's any change whatsoever, because news flow is changing pretty fast out there. Not so much local, maybe local as well, but global definitely. Thanks indeed once again, Amish. Well, let's talk about Crompton now. That's the first corporate now joining us after markets have opened. Third quarter revenue growth has been subdued. Profit has met street expectations. Margin is above estimates. We have the management with us to talk to us about these numbers. Kaleeswaran Arunachalam is Group CFO and Head of Strategy at Crompton Greaves Consumer Electricals joining us now. Sir, good morning. Great to have you with us here. Thank you very much for your time. Before we get into individual segments and the performance of the third quarter, there is this one view in the markets, and I'd like to pose that to you. that companies like you, small appliances, etc. I mean, those are sectors which could benefit because of the tax cuts which have been proposed in the budget. Do you think you could be a beneficiary in maybe in the second half of 26? Do you have a view?
Hi, good morning. I think we do believe that it's a great initiative by the government to reduce the personal tax burden. And this is going to give sizable disposable income to target customers that we look up to. And probably around festive, we should start seeing the benefit of this rolling in. And it could be broad-based also. Across consumer durables, we do see the positive impact of this rubbing off.
Which typically, I mean, which kind of segments will this show up in? Product categories, rather?
See, for us, we have seasonal products. Our large season is in Q4 and Q1, which is fans and coolers led. Subsequent to that, we have other categories that will come in. And probably around Diwali, we should expect kitchen to lead the growth, followed by the other categories.
All right. Hi, sir. Morning. Good to see you in. Tell us about your market share. I think in the fans premium segment, it's at around 25% or thereabouts, but you have a vision to take that up further. So update us on the market share. By when do we see higher levels in terms of a market share, and also comment on the competitive intensity in this space?
Yeah, so before market share, I would like to also talk about the initiatives that we're doing, which will drive the market share as an outcome. I'm very happy to share that we have come out with an indigenous developed platform on fans for both BLDC and induction. We think that will be industry leading, something that's going to be pretty much differentiated and would be loved by one and all. We do have a launch that is planned in about a week from now. Watch out for the space to hear more on this. We think that's going to be really disruptive and differentiated to the fan segment. It's also going to augment our premiumization journey in this. We talked about our share of premium, which used to be about 18% of the business. Today, it's close to 25 as we speak, and our endeavor is to take it up to 40%. This would be led by both BLDC and by the induction segment. Outside this, we are also seeing good amount of growth in fans coming from TPW and summer, which we expect to be similar to last year in terms of the weather. We expect the benefit out of that, and the outcomes should be really positive.
Got that. I think last year, that is, but I just want to get the latest, right? On the lighting segment, how is pricing looking? Because you'd earlier indicated intense competition in that segment. What is it looking like? Yeah.
See, while the competitive intensity for all other categories are high, I think we continue to be a market leader in the segments that we operate. Not for 1 year, 2 years, it has been for decades. That's mainly because of the brand and the kind of investment that we are making behind the brand and innovation. Specific to lighting, I think more than the competitive intensity, price erosion was largely due to the technology upgradation, which ensured that at scale, the prices came down significantly. And we expect that journey to continue for some more time. Having said that, as Crompton, we came out with the thought process where we said our first endeavor is to arrest decline in lighting and then start driving growth. I'm very happy to say that as we speak, our B2C segment probably is growing at an industry leading rate right now. And on top of it, we have held on to margins in spite of investing significantly behind lighting business on marketing also. This is led by also mix upgrade. Our panels and ceiling lamps and lighting segment has gone up. Our overall go-to-market initiatives that we have worked out on lighting is also starting to pay dividends right now.
Okay, let's talk about Butterfly then. Out there, that was a positive surprise actually, particularly in the profitability aspect. And you all have indicated that most of that restructuring that had to be done is done. Could you tell us what is the trajectory in terms of growth and the profitability as well for Butterfly? Because if I look at it, I think in the last quarter, you're doing 220, 230 crores or thereabouts of revenues, but profitability has jumped up. So what should we work with just on this one?
See, Butterfly, there has been a slew of initiatives that has been taken. It started with a leadership change. We wanted somebody who understands kitchen as a segment to drive this. And we called out clearly that it's going to be a business that will go through a transformation journey. H1 was more about arresting the decline in revenue, do all those stuff which will help us to reach there. So we did that. And as we got into Q3, the revenue decline has already been arrested. In terms of profitability, there are 2-3 initiatives that has been taken. Calibrated price increases have been taken across segments. Our margin model has been reworked with our channel partners. Some of the overall indirect spends has also been optimized. Plus, one of the things that we also talked about during acquisition is leveraging synergies of Crompton and Butterfly together. There are areas where Butterfly has got good backward integration on manufacturing. We are leveraging that platform for Crompton to benefit on mixer grinders. Similarly, there has been work done on logistics and warehousing to have common warehouses and transporters to reduce cost. So overall, it's kind of a 360-degree work, both on revenue management and cost management. It's moving in the right direction. And as an outlook, we think this business should start now growing in double digit next year. And our endeavor is to take the margins also close to 9 to 10% EBITDA from where we are today.
I now got that. On solar pumps, sir, could you give us a sense? How large is that business? Because we've seen government focus very much there. But again, it's a place with lots of competitors and many of them now making it to the listed space.
Yeah, that's true. We are very excited on the solar space. I think that's one to watch out for. We are happy to share that as we speak, we have already crossed cumulative 200 crores of order execution in solar. And moving forward, and most importantly, it's critical to note that it's a business that has got good profitability, and working capital management is also reasonably strong in this. Now that we have got into it, we have got a platform on which we have established, and there is credentials brought in with about more than 7,000 to 8,000 of pumps already being installed. We think this can be accelerated to the next level as we look at next year. The road is pretty strong. I think our endeavor is now how do we build an order book that will help us to accelerate this even further to where we are today.
Okay, all right. Thanks a lot for joining in, sir. Wishing you all the best. And we'll look forward to having a chat with you sometime during this quarter. As you said, the bonanza that came in from Budget 2025 should play out in the second half of this year. Let's focus on another stock, Bharat Forge. That stock is a little under the weather. It's a little bit lower after it missed street expectations, and the stock has lost 35% from the recent peak. To discuss what's the outlook from here on, we are joined by Mr. Baba Kalyani, the Chairman and Managing Director at Bharat Forge. Hi, Mr. Kalyani. Good morning, and always good to see you, Ben. Well, let's focus first on this uncertainty with regard to tariffs. Is there anything you're hearing from your customer base because of these tariffs that could potentially be levied on Mexico, Canada, and some of them, they're important markets for you, right? So your take?
Yes, I mean, North America is an important market for us. Europe is an important market for us. Of course, India is also an important market. The tariff situation is still fluid. We don't know exactly what's going to happen. Only the two tariffs that we have heard, which are going to be put in place in the next few weeks, is the tariff on steel and aluminum. And that largely comes out of Canada, Mexico, Brazil, and some out of Europe. One action that we are seeing because of tariffs coming on aluminum is we have aluminum manufacturing facility for components in the U.S., and we seem to get suddenly a larger traction in terms of people wanting to buy. But, unless that gets converted into a buy, we can't be sure for what's exactly going to happen. So we have to wait and watch how the tariff situation unfolds. We haven't seen the reaction from Europe yet on tariff. But it's a fluid situation. It's not something that is normal business.
Mr. Kalyani, good morning, sir. Prashant this side, and always good to see you on the program. It's a fluid situation. But as someone who's been in the business for a long time, and you've sort of associated with, and you've got a large presence in the US, etc. as well, could broadly the thrust of this new administration sort of, in a way, impede, and here I'm referring specifically on the defense side, some of the Make in India initiatives. It's a large, high-value area, very visible, right? India is the largest defense importer, and we're trying to change that. But buy from the US could, and of course, make in the US, could it, in a way, could that be a road bump towards our efforts and our companies here, sir? Mr. Kalyani, can you hear me? We lost the line. We'll try and have Mr. Kalyani back on in just a bit. But Bharat Forge and, of course, the defense opportunity that Bharat Forge is looking at is also very large. And we'd like to get that clarification from Mr. Kalyani as well. So hopefully back soon.
Yeah, by the time we get him back, Prashant just wanted to highlight that actually the markets went down 50 points in the red, but we have taken support at around 22,950 and we have bounced up from there. You'll want the Nifty actually to move to around the 23,200 odd mark, just purely because it's the expiry day. And the positioning is such that we don't get past that mark, 22,150, 23,150, 23,200, which is the options data indicating. So for the timing, we have moved towards there. The bears are counting on that mark not breaking out. But Mr. Kalyani is back, so let's go
Absolutely. Mr. Kalyani, Prashant here. I don't know if how much of my question you heard. My question was with regards to defense. We're the largest defense importer. We're trying to change that. It's a very large, high-value, visible item. And of course, the US most likely will try to tell us to buy more from the US. Is that in any way, will that stand in the way of what we're trying to do here, which is make in India and substitute some of these imports?
Absolutely not. Matter of fact, I think, you will get pushed to buy more things like jet aircraft, fighter planes, and things like that. So I don't think it will impact what you make here. I think the defense opportunity is going to continue to grow. And at least for us, we see the defense opportunity on a growth path.
Okay, since we're talking about defense, could you tell us what kind of numbers we wish to work with, Mr. Kalyani? I recall in the past you were doing roughly around 250, 300 crores per quarter. That number went to around 500 crores. But in the past quarter, again, it was in that vicinity of around 350 crores. So what kind of revenue?
It will keep, defense is a lumpy business,
Yes.
Once you execute an order for a high value item for that quarter, this thing will go up. So you please look at it from a year to year basis, and year to year, we will continue to grow our business double digit. That's for sure.
All right. So for the next year, if we want to put in a number for the defense business, should you be in the ballpark of around 2,200, 2,500 crores for FY26?
Yes, somewhere around there, yes, sure.
Somewhere around that mark. All right. Also, Mr. Kalyani, so that's about the defense vertical. You're sitting a good order book, more than 5,000 crores. So 2,200 to 2,500 crores of defense revenues.
Our aim also is to take the order book to 10,000 crores.
Okay. And execution would be what then if you have to get to numbers? 26 will be 2,200 to 2,500 crores. 27, how much does it go to?
I think every year it should increase by a double-digit number.
Okay.
Normally, defense orders, that's how it grows. We are expecting the ATAGS order to be finalized by March end. That's what the MOD has said. So that is an order that will go on for, in terms of execution, for 3 years.
Okay.
And then that will be followed by other artillery orders and other products that we are developing for the Indian defense, Indian services. So there's a lot in the pipeline, a lot, plus exports, of course.
All right. So 2,200 crores with a double-digit growth at least is what we are looking at from there on. Got that. And that would mean that as a percentage of your total consolidated revenues, it'll be roughly around 13 to 15% or thereabouts. But tell us about business the year and now. I recall in the first half of the year, you said the second half of the year will be better. But in quarter three, you've seen a bit of a degrowth. Will quarter four at least be better?
For the first time in our history, we have had a quarter which I can't even explain to you. It's been a difficult quarter. It's been a combination of what's happening in Europe in terms of the slowdown, especially in Western Europe. And of course, to a large extent, we have had issues in terms of transportation. With our defense business, that kind of slowed it down a little bit, and some of it is, I would admit, it's also been our execution was not as good as what it needed have to be, and of course we have a large baggage with our overseas subsidiaries, and we are going to fix this once and for all in the next 6 months. One way or the other, that will get fixed.
So then. Quarter four, we'll get back to a growth on a year-on-year basis. Quarter three had a lot of pain, but quarter four, at least on a year-on-year basis, we'll see growth?
Quarter four will be better than quarter three, for sure.
Okay.
On year and year, it may not be as good because if you remember Q4 last year, we had very peak defense export orders, export revenues. And those are finished. Those orders have been executed. And the next orders will only come in after March.
Okay, all right. And you just mentioned about subsidiaries, consolidated minus standalone. That's still delivering a net loss of close to 100, 110 crores on a quarterly basis.
Yeah, so we want to get rid of that problem.
So that will turn.
That's the challenge for the next 6 months. We need to fix it, and we will fix it.
And you'll turn profitable on that, on those subsidiaries.
We'll turn profitable or figure out some other way.
Mr. Kalani, I latched onto that some other way. You said one way or the other will fix it. What's the other way?
Can't go on with the problem for a long time.
Absolutely.
And it's not possible, okay? It just takes away too much of time and management and creates headaches.
Yeah. But any other, I mean, you want to fix it, but one is, of course, operationally trying to work through things, but are other options also on the table?
Yeah. Everything is on the table. I can't announce it because it has other implications, but we are at least doing a deep dive and deep study into it.
So you could possibly look at a buyer then?
I can't say anything about that. That's
okay, but
you can't put words in my mouth on that.
No, you'll fix the problem, sir. We're just taking note of that.
But it's logical that not completely wrong, right? To suggest that maybe that's also on the table, although you're not saying
wrong.
anything.
No, not wrong. But I've said we'll fix it in 6 months. We'll fix it.
Okay, all right. That's a very, very emphatic statement. Mr. Kalyani, thank you very much, sir, for joining us here on CNBC-TV18. It's a pleasure having you with us here and speaking to you about the business. Well, time for a quick commercial break here. I think the market is doing what it is doing, a bit of a dip, then a bit of a recovery, but lots of stocks are moving big at this point in time. Muthoot Finance is one of them, and we'll connect with the management on the other side. Very strong numbers. Stay tuned. Okay, welcome back. We have the management of Muthoot Finance now joining us. Stocks are surging as we speak, and why not? I mean, gold loan segment has posted a very, very strong rate of growth. The loan growth has been 37% on a year-on-year basis. Let's welcome in Alexander George Muthoot, who's Joint Managing Director at Muthoot Finance, and he's with us now to take some questions. Mr. Muthoot, good morning. Great to have you with us here on the program. Prashant this side.
Good morning.
37%, you've done better than, I think, most banks. So tell us, will you sustain this rate of growth? You've set expectations high, and we'd like to know whether you'll do this better in the fourth quarter.
Okay, but before I get into that, let me just reflect on our 9 months journey so far on this business transformation, which has been a record-breaking quarter for us. We've had the highest ever consolidated loan asset under management with 34% Y-on-Y growth at 1,11,308 crores. We've had the highest ever standalone loan AUM with 37% Y-on-Y increase at 97,487 crores. And we've had the highest ever consolidated profit after tax in the first 9 months of any financial year, with 19% Y-on-Y increase at 3,908 crores. We've had the highest ever gold loan AUM growth with 34% Y-on-Y growth at 92,964 crores. And our
Mr. Muthoot, apologies, we have all the numbers and the numbers are all being flashed as you speak, sir. I'm sorry. And they're very good, absolutely. So appreciate you highlighting all of those. But, you know, we have a limited time, so that's why I sort of pushed you with that number, loan growth guidance for Q4, sir.
See, we usually give a guidance of 15% every year. We've already crossed that by about 29%. We've just started Q4. We are very optimistic and positive that Q4 will also be a very good quarter for us. We're doing a lot of initiatives on the business transformation, on the lead acquisition strategy. We've had the highest ever actually loan disbursements to new customers. Our thrust on new customer acquisition in this financial year has been significant. We've added almost 13,70,178 customers and disbursed loans of 15,723 crores. So our thrust on new market expansion, new customer acquisition through a lot of our digital mediums, also our omni-channel mediums, digital marketing, a lot of branch expansion that has happened. So our thrust on new customer acquisition stands, and we will definitely are positive of a good Q4 also.
And we've asked this to Mr. Muthoot Senior when he's been on the program earlier, that, you know, there's this perception that gold loans increase, demand increases when actually the underlying economy is weak. And the economy has been going through a bit of a downturn. So I guess that question does pop up, whether this gold loan surge will continue and for how long. I don't know if you want to take a shot at it.
See, I would say that look at our performance over the years, over many financial years. It has not just been this financial year. Over many years, we've been giving consistent growth and we've been growing from strength to strength every quarter, every financial year. So our thrust of expanding the market through a lot of attitudinal transformation initiatives, because India as a market has 25,000 tons of gold, which is lying unproductive. We are unlocking this dead asset and putting it to productive use. I think that thrust on the attitudinal transformation in the customers is growing by leaps and bounds every year, purely because of our significant investments that we make into marketing, working on the attitudinal transformation of putting this dead asset to productive use. So I would not suggest it is just a reflection of the economy, but also the focus that we have as an organization, being a category leader, industry leader in the gold financing segment, to open the category and expand the category to a whole new set of new customers. And that is a reflection of all the new customers that we've also added this financial year. And that has been a testimony to all the initiatives that we've done on the marketing and the digital front.
Okay, all right. Hi, good to see you, Mr. Muthoot. Could you give us a couple of more details, with regard to growth? And the street clearly likes what you're saying and the kind of numbers that you've delivered as well. Your stock price is at the high point of the day. Now, give us a couple of details. Have you been able to take away market share from any other lenders, like, say, banks? So that's one. And the second point is your NIMs have improved on a year-on-year as well as on a sequential basis. And the incremental cost of funds should start dipping, given that we have seen a rate cut, but it should flow through with a lag. So could you tell us, how do you see your incremental cost of funds decline and what impact will it have on your NIMs?
Okay, first of all, I think one thing that we do, because we have a vast distribution network, we build a lot of operational efficiency into these branch network that we have, because it's a significant branch network, over 7,000 branches. So we have always ensured that the per branch productivity is increased. And this time we are at a record 19.15 crores of gold loan AUM per branch, which was about 14 crores. So we added almost 5 crores of productivity in this last 9 months itself. So this is a huge operational efficiency that we are building up. On the cost of funds, yes, currently we are about approximately about 9%. Now with the rate cuts that have happened and the banks passing on that cost to the customers, we will definitely hope that we also get that kind of a rate reduction in our cost of funds. And we've also diversified our cost of borrowing across various things. We have also done ECBs also. So I think overall, all in all, like I said, our thrust towards this specialization that we have on the gold financing fund, building operational efficiency, increasing per branch productivity, and also ensuring that we get the best to our customers through our gold standard customer service. I would not suggest that we are taking away share, but I would say we are expanding the category. And the expansion of the category comes with this new customer acquisition and this attitudinal transformation, which I talked about earlier, through various marketing initiatives, digital initiatives that we're doing to a whole new ecosystem of customers, is definitely resonating very strong, and we're expanding the category as such. So as industry leader, category leader, depends on the category expansion.
Okay, got it. What about, you were talking about your cost of funds. What does it mean in terms of NIMs from here on?
I wouldn't give a guidance on the NIM per se. Right now, we are about 11.57%. I think we'll remain around that range itself. Because like I said, with the expansion and a lot of work that we're doing on the operational efficiency, we're around 11 to 11.5%. So we'll remain probably at that same segment.
You know, Mr. Muthoot, on the housing side, there was robust loan growth, but PAT was weak. What happened? And also, what is the housing finance subsidiary concentrating on? Affordable housing, prime ticket size, luxury? Give us a sense.
So our affordable housing is primarily on the affordable housing segment. We had a little surge in our cost of borrowing. That's the only reason why the PAT has come down a little bit. But we are growing significantly in that area also, because we have a huge set of customers in Muthoot Finance, and we're able to cross-sell to this set of customers also. So we remain focused on the affordable housing finance category.
Belstar, the MFI, we saw pain, but in line with your guidance. How long will the pain last, in your opinion?
I think it's a category issue. I think it's not just our microfinance wing, but I think over the next 2 quarters, things should get better. So I'm looking at, I think, about approximately 2 quarters for things to improve in Belstar. We have a self-help group that we work with. Our collection efficiency is over 98%. And so we are very well positioned there also because of the self-help group that we currently work with. So we're very hopeful over the next 2 quarters or so, things should stabilize much better.
And then maybe if it starts improving, then in FY26, as hinted earlier, we see an IPO?
Well, it is still a board decision. So let's hope and things improve, and then we'll take a decision at the board regarding that.
So at some time of FY26, right?
Yes.
Okay, all right. It's a pleasure talking to you, Mr. Muthoot. Thanks a lot for joining in. For the time being, your stock price is one of the outperformers, going by the past quarter's numbers and going by the guidance you've given as well. 6.5% high. The markets on the whole as well have seen a good bounce. We'll slip in a short break. Mitesh Thakkar is waiting for us on the other side.
1.5% higher on the mid and the small cap index. The advanced decline ratio has 4 stocks advancing for 1 in the red. Honasa 5%, PTC India up 4.5%. Vodafone Idea 2 has bounced back. BHEL is a big mover. Zaggle, after seeing lower circuits for 4 or 5 days, today is up nearly about 3%. So lots of gainers on the way up. But Mitesh is now with us for 9-10 calls. Mitesh, it's getting stronger.
Yeah, it is. So I think, one, it kind of confirms that 22,800 now should be taken as a temporary low. Two, I think this also paves way for us to head towards 23,350, 370 zones. Now that's a very important level. So I'm hoping that, we go till there. That will give a lot of exit to people who have been stuck at high levels. And if we start getting past that, then we look at further upside. So for the timing, I think, the market actually looks like on the lower side, you will see some demand as well as short covering, and you might see pressure around 23,350 also.
What level, Mitesh? Sorry, pressure at what level? 23?
350, 370 is what pressure.
Okay, so a run till there at least before we start. Do anything
that's what
else.
I'm looking at. Right.
Yeah, okay. Stocks, Mitesh?
So I have a buy on SBI cards. That's a buy with a stop at about 840 for targets of 890. And SJVN or Satluj Jal Vidyut Nigam, I think that's a stock, which is showing early signs of bottoming out around this 90 mark. So we'll take a stop at about 89.5 and look for a target of around 96.
Okay, in fact, SBI Cards has got an upgrade from Macquarie. Abhishek is here to tell us more. Abhishek.
Macquarie has upgraded SBI Card to outperform from neutral that they had earlier, increased the target price to about 1,000 per share from 750 that they had earlier. They said that the tide may be turning, and their channel check suggests that credit card slippages are plateauing. So vintage delinquencies as per CIBIL in credit card has been consistently coming down over the last few quarters. So they expect credit costs to start declining materially in next 2 quarters for SBI Card. So they have cut their earning estimate anywhere between 13% to 15% given the lower loan growth, net interest margin and fees impact. However, they say that reduction in sustainable credit cost will actually increase their sustainable return on asset by about 30 basis points to about 4.5%, and that is why they have upgraded SBI Card to outperform from neutral. Back to you.
All right, Abhishek, thank you very much for that. So that is the view coming in on that one. We'll take a quick commercial break here. It's the economy on the other side. My colleague Lata will be speaking with Jayan Mehta of Amul, Roosevelt D'Souza of Nielsen IQ, and Anjan Chatterjee of Specialty Restaurants on how much consumption is picked up in the fourth quarter, Jan to March. Stay tuned. That's coming up.
Welcome to It's the Economy. As the third quarter results season ends, one unhappy conclusion is that the sales of FMCG companies have been a disappointment. Hindustan Unilever, Dabur, Patanjali, ITC, Emami have all reported flat or low single-digit volume growth. Value has been a little better because of price increases. However, Nielsen IQ, the market research company, said in a recent report that overall sales volume grew by 7.1% in Q3, while sales by value grew by over 10%. So there is a dichotomy here. In sharp contrast to all this, the IIP numbers that came yesterday said that consumer non-durables, which means FMCG, their output contracted by 7.6% in December. So given all this confusion and to get a 360-degree perspective, all the nuances of India's consumption, I have with me Roosevelt D'Souza, the head consumer success FMCG at Nielsen IQ, Jayen Mehta, the managing director of Gujarat Cooperative Milk Marketing Federation, and hopefully another guest will join us. But first, Roosevelt and Mr. Mehta, thank you very much indeed for your time. Roosevelt, how do you explain this so-called dichotomy? When the individual results came, HUL said flat, Patanjali said flat, which means zero volume growth. While some of them, of course, Emami and all have given 5%, but your numbers look much better. Who's growing?
Firstly, good morning, Lata. Thank you for having me back on the show. I don't see this as a dichotomy. If we look at for the first time this quarter, the growth in value is actually coming because of price growths. The first time we're seeing price growths, the last time we saw this was, I think, June quarter 23. And after that, there has been a suppression of price in the market, which are not really being passed on to the consumer. We're seeing that happen in quarter of July, August, September, coming up at about 1.5% price growth. This time we've seen 3.5%. So if you look at the volume growth at 7%, along with the price growth, if you add that, that's when you get a value growth in double digit. So to me, if you actually remove the price growth, the volume growth is marginally higher.
Yeah, but it is still higher than almost all the individual FMCG companies whom we cover as listed stocks. So that's the dichotomy I want to understand. Is it that, smaller companies have grown well, unlisted companies have grown well?
Exactly to my point. I think if we look at always the large companies, and we do agree, we call them giants in our own internal parlance, and that is like they're going between 1 to 4%. These are companies which are over 5,000 crore turnovers. It is where we're actually seeing double-digit growth are the small and what we would actually call the regional players, who are more focused on couple of states here and there, and that's where we are seeing a huge influx of growth coming from them, which is actually pushing up the overall growth. So we are also in line with what the large giants growths are getting reported. But if you look at the overall industry, that's where we actually see the small players having a big impact.
Okay, that chart is just coming up. Yeah, there you go. Consumption growth by volume for small companies. If you can have that chart up again, that's grown much better than what we call giants. That's important. Mr. Mehta, you all cover the entire category. You all sell to a lot of small people, but you are a giant in yourself. How has the sales experience been in Q3? In volume and value separately?
Yeah, Q3 was very good. We had almost 15% growth, almost the same in quantity as well as value, because we didn't take any price hike except for a small increase in milk, which was earlier in the year. So it's been a good quarter, as we had discussed earlier also on the same channel. And the next quarter, which is the current quarter, also has been doing good with almost 22% growth recorded in January and almost the same numbers we are looking at February and March. So
22% year-on-year growth in dairy products.
Yes, that's been our best ever growth and the best ever turnover over the last 50 years of GCMML.
Okay. I think the Amul numbers will come up in just a bit, but that is massive. Roosevelt, what are we seeing over here? I mean, here is, an unlisted giant telling us that their volume has grown by, 15% in Q3, and in January by 22%. That's a massive growth. Is it that the listed companies are getting something wrong? And, there are others that urban consumption is not a problem, but specific companies are not getting it right.
I'm qualified to really differentiate between listed and unlisted companies. When we represent the entire FMCG industry. Okay. And so I'm not really surprised when I see results from Amul. See, what is happening is that the regional players with regional focus, they're actually really going deep into, more in terms of distribution, in terms of coverage within the region before they get into, let's say, even into at a national level. And that's where you're seeing the growth pockets really, coming up, and probably that the penetration of distribution is what is helping them grow. So if you look at it from a very macro perspective, it looks like, okay, it's a 10% growth, but actually when you start unpeeling the onion, that's when you'll start seeing where actually the growth is coming in. And earlier you showed that chart, 9.5% kind of volume and value growth coming from the small and mid-sized players.
Mm. Yeah, so what we are seeing is Amul is growing by 15%. A number of the small companies that you pointed out are growing close to 10%. I think the small company number was 9%. I'm only talking volume now. The giants are reporting, flat zero or maybe less than 5% growth, 4.4% as they put it. Mr. Mehta, what's your sense? Is this poor penetration? What's going wrong here?
I can comment on what others are doing, but as Mr. Roosevelt mentioned, yes, we have to focus on the basics. It is basically the width of distribution that you have, the depth of penetration of the products that you have in the market, work on every single category you operate in. Also, not lose sight on what's going to happen for tomorrow and prepare for the tomorrow's customers. And all these things you do together and be omni-channel. I think that's the way forward, because the Q-commerce, e-commerce, the modern format stores, our own Amul parlors, and the 20,000 distributors that we have covering more than 1 million outlets on our direct basis is actually driving growth here. And we expect a much better growth also in the period to come, because we are entering the main marriage season. Summer, early summer is also there, and Ramzan and other festivals are also coming.
Okay. Yeah, of course. Amul Chas, I guess, will be very important once summer starts. But Mr. Mehta, the bigger problem that Amul may face will be if the US insists that we bring down tariffs, or they will impose competitive tariffs, reciprocal tariffs. Now, I checked up the tariffs on milk and dairy products is 30%, in fact 30 to 40 if you go to sweetened yogurt, etc. How do you think this will impact Amul in case we have to bring down tariffs to whatever, 10% or something?
We already have a TRQ in place as far as the dairy products or skim milk powder is concerned. So while the duty on skim milk powder in India is 60%, if you import the 15,000 tons under TRQ, you'll get at 10% or so. So we don't have a challenge on that front. Plus, US is not US is not looking at India as one market for exports of their milk powders. In fact, it's on the other way. We are also a local player in the United States now, and Amul is perhaps the only brand of milk which is available coast to coast in US. So we'll play both sides of the game.
Oh yes, we were told about this in the course when we were discussing tariffs. But if your import of skimmed milk or dairy products is brought down to say 10% from the current 30%, you don't expect Amul will have to drop prices here in India? You think you will still be profitable?
We would not encourage any imports, and dairy is one category which has been kept out of every single free trade agreement. So,
no, I agree with you, sir. I agree with you. The government has been extremely correct in protecting, vulnerable segments and important segments in India. But at the moment, we are faced with a different kind of geopolitics. If, there is a gun to your head, and if the tariffs do come down to 10%, is there a genuine import threat, or will you all still be competitive?
We have to be competitive on a long-term basis and not short-term basis. So it is better that the government doesn't take these steps, and we are sure that these discussions don't happen just in a jiffy. There is a long negotiation process, and it's not just for US, it's for every single country of the world. And these tariff cuts are not bilateral in any case. So we are not too much worried about it, because 8 crore families depend on milk for livelihood, and the government is prudent enough to see that we don't put their livelihood at stake just for such trade deals.
I do not for a moment doubt the government's intent. This will be the last thing they will want to sacrifice in the entire bargaining list. But I'm just asking you arithmetically, if the tariffs had come down, will Amul product still be more competitive? Will it still be, sellable?
Obviously, they will sell, because if there is milk, you have to sell. But it's not just US. There are many other countries who want to dump their surpluses into India.
Okay, okay.
And
so if it is a 10% tariff, there is genuine danger, is what you're saying?
Yes, absolutely, absolutely. Except for once you cross the TRQ level of 10,000 tons, obviously it will be a case of worry. Because at 10,000 tons, you still get at 15% duty, you can import.
Okay. All right. So it is important that that threshold of 30% tariff is not brought down. I take your point on that. Right? I understood you right.
Ma'am, look at the other way. I mean, we export to US our butter, our ghee. There is a duty ranging from 30 to 60%. So it's not, they give us a duty-free access to their markets, and we charge them duty. In fact, US charges high duties on dairy products. Then
in reciprocal, we win over there. Okay, I get your point over that. Roosevelt, before I come to you, I think we've got Anjan Chatterjee finally, but it's only on the phone line. We are not able to connect to him on video. Anjan, good morning, and sorry, we are just not able to get your video right. There's a problem with the lines. What has been the experience at specialty restaurants in January itself? Has the consumption in volume terms improved over Q3? And how was Q3 in volume terms over a year ago?
Lata, as you know that you go out to mainland China's of the world and you go to all our favorite restaurants. So OND, that's October, November, December, is the best season for, by and large, every food and beverage company. So it was the best, as per the comparisons. But we've definitely shown a growth of around 6%. And there is a humongous amount of tailwind at that point of time. Shadis, people going out.
What about January, Anjan? Was January also 6% higher than a year ago?
Not really, because, as we talk about, once the tailwind goes away, you see comparisons of, economy being whatever it is, accepting the fact that the new tax regime which has come in, because we are at the upwardly mobile customer, wherein every penny counts for them. And there's been inflation in the economy, and there have been lots of challenges. Food prices have gone up. So there is a budget. They have a budget, but definitely over a period of time, I think Jan has not been as good as the JFM, that's January, February, March, would not be as good as the quarter which
October,
passed
November.
Quarter 3. So there will be challenges. It's become a bit of a food and beverage is becoming slowly a bargain economy, because if you see, unless you have a very strong brand, you will see people bargaining, asking for discounts, etc. But we are very hopeful, because our same-store growth has been very good, very steady, and we are very hopeful going forward.
Okay. Well, I'm taking a lot of hope from what Nielsen has put out in terms of data that small companies have reported both in volume and value, very good numbers. Just a final quick question to you, Niels. Roosevelt, is there a premiumization trend or a consumer downtrading trend?
I think that this is where we see some interesting observations. So while we've always been talking about premiumization, and premiumization also has been growing almost at 10.6% this quarter, but that's been like 8, 9, 10, and 10.6%. Interestingly, what we're seeing the mass brands or masstige is where for the first time this quarter it is doubled sequentially, and it's also at 10.6%. So what this basically tells us is that there is a segment that goes after premiumization, and that's going to remain. But we're also seeing the mass people who are going after mass brands. That's where it also ties in very strongly with the local player story.
Yes.
There is a price
small and mid size.
There is a small pack play there. Okay, they're actually bringing so much out in the market, and there is a consumer for that as well, and that's why we see that growth also going up. So I think there's play at both ends of the spectrum.
Okay. Thank you very much, Roosevelt, Mr. Mehta, and Anjan. Anjan, very sorry for the very brief chat, but I think these are very positive takeaways. Amul telling us that this year, this quarter, they're going to see a 22% growth in sales, volume and value included, and they're not taken much price rise. And Nielsen telling us that small packs, unit items have done much better than the larger companies and the larger packs. That is an extremely positive story in terms of consumption at the bottom of the pyramid. On that note, we wrap up on Bazaar Chartbusters coming up.